2024 was supposed to be the year that the US dollar bites the dust. So far, the dollar is hanging in there, defying market consensus. A weak dollar requires lower US interest rates. But the continued resilience of the US economy is not giving the Federal Reserve an excuse to start cutting interest rates. However, 2024 is still young. Which major central bank will be the first to cut interest rates, and why? Which currencies will do well, and which poorly? And what does productivity growth have to do with it? For the dollar to go down, either the euro, the second most traded currency, or the RMB, the currency of the second largest economy, will both have to go up. Given the importance of interest rate differential as a driver of exchange rates, for that to happen, the Federal Reserve will have to cut interest rates ahead of the ECB and the People's Bank of China, and cut more aggressively. I have argued in another video that China should not wait for the Fed to cut interest rates. But what are the chances that the Fed will cut before the ECB? Continued US growth outperformance suggests the chances are slim. US GDP growth averaged 1% in the second half of 2023 and is expected to be 0.6% this quarter. Eurozone GDP didn't grow at all in the second half of 2023 and is expected to increase by only 0.1% this quarter. However, despite the underperformance of the Eurozone economy, the ECB seems distinctly less enthusiastic about bringing down interest rates than the Federal Reserve. While Christine Lagarde, the ECB president, reiterated this week at a conference of ECB watchers that the ECB will consider bringing down interest rates in June, she refused to commit to a particular path of interest rates after that. In contrast, this week, the Federal Open Market Committee did not change its forecast of 3 cuts for 2024, despite the fact that inflation has surprised to the upside over the past 2 months. Wall Street is taking its cues from the central banks. The market is pricing a little more than 3 cuts from the Fed and a little less than 3 cuts from the ECB for 2024. After that, it is pricing that the same interest rate differential will persist in 2025. Does this make any sense? Two key indicators encapsulate the most crucial differences between the major economies at present, at least as far as monetary policy is concerned. One is labor productivity, defined as GDP per hour worked. The other is labor compensation per hour worked. What you see on this chart is the year-on-year change of labor productivity of a selection of OECD countries. The data from the third quarter of 2023, the last quarter comparable data from the OECD, is available. The most striking part of this chart is the disparity of labor productivity growth across these countries. At one end, we have Japan, the US, Israel, and South Korea that saw an increase in labor productivity. At the other end, we have Australia, Canada, Italy, and Germany that witnessed a decrease in labor productivity. Labor productivity is a measure of economic efficiency. It goes up when the same amount of labor input produces more goods and services. Labor productivity growth is the most important source of economic growth because it is the ultimate driver of per capita income and the main determinant of the absolute and relative standards of living in different countries. The fact that it is still going up in Japan and in the US at this late stage of the business cycle is a big positive for these countries. The fact that it is going down in Europe, Canada, and Australia is a concern. What should be an even bigger concern for Europeans, Canadians, and Australians is that what happened in the third quarter of last year was nothing more than a continuation of a pattern that started with the pandemic. For whatever reason, COVID and the Russia-Ukraine war have resulted in a significant divergence in the level of labor productivity between countries. What this chart shows is that labor productivity has increased by 5% in the US since the end of 2019, and by 3% in Japan. At the other extreme, labor productivity has declined 4% in France since the end of 2019 and nearly 2.5% in Australia. This means that US labor productivity has increased by nearly 10% relative to French labor productivity in the space of just 4 years. Economic theory tells us that all else being equal, countries with higher labor productivity growth should also have higher return on capital. This means that they will have higher real interest rates. In this respect, the high labor productivity growth in the US should be viewed as a major support for the dollar and US equity outperformance over the past 2 years. Now let's turn to labor compensation per hour worked. What you see on this chart is the year-on-year change of labor compensation per hour worked in the third quarter of last year. Once again, you can see that the range among our sample of OECD countries is very wide. At one extreme, we have Hungary and Australia with relatively high wage growth. At the other end, we have Japan and Switzerland with relatively low wage growth. Between the two extremes, we have Germany, France, Italy, Canada, and the US, with US hourly compensation growth lower than that of the others. In theory, wage growth should be a function of how tight the labor market is. However, it is not clear the fact that wage growth in Europe was higher than wage growth in the US in 2023 was because the labor market was tighter in Europe. My guess is that the greater importance of collective bargaining in Europe had more to do with it. Also, labor hoarding could be more prevalent in Europe than in the US. Whatever might have been the reason, with the unemployment rate in Germany and France rising, my expectation is that wage growth in Europe will moderate considerably in 2024. When we divide hourly compensation by labor productivity, we get unit labor cost. Unit labor cost is a measure of the labor cost associated with producing just 1 unit of GDP. When labor productivity growth is low and wage growth is high, unit labor cost growth is high. When labor productivity growth is high and wage growth is low, unit labor cost growth is low. What you see on this chart is that unit labor cost growth is higher in Australia, UK, and Germany than in Japan, Korea, the US, and Switzerland. High unit labor cost growth is probably the single most important reason why the ECB and the Bank of England have kept interest rates high despite near recessionary conditions. On this chart, I plotted the time series of unit labor cost growth for the US, Japan, and Germany over the past 5 years. What you can see is that Japanese unit labor cost growth has returned to zero by the third quarter of last year. This explains why the BOJ took its time to exit from negative interest rates. Similarly, unit labor cost growth in the US was back down to 2%, close to the pre-pandemic level. This is one reason why the Fed is so confident about inflation returning to its 2% target soon. In contrast, unit labor costs in Germany, which had been accelerating since the end of 2022, was still running at 3 times the rate as in the US in the third quarter of last year. What does the above analysis tell us about the outlook for interest rates and exchange rates for the major economies in 2024? Low unit labor cost growth makes it easier for companies to maintain, if not to expand, their profit margins. In this respect, the relatively low unit labor cost growth in the US and Japan make these economies more attractive for investment. The latest Business Roundtable survey shows a surge in capex intention in the US. This should help support job creation and keep the labor market tight. In the case of Japan, a pickup in wage growth has allowed the BOJ to finally exit from negative interest rates. The BOJ will have room to raise interest rates further in the coming months as inflation stabilizes around 2%. In the case of the US, this could mean that 4% unemployment rate and 4 to 5% wage growth are here to stay. This means even if the Fed were to start cutting interest rates in June as expected, the cuts won't be very deep as the economy will likely avoid going into a recession. For now, I'm assuming that the current above-trend labor productivity growth continues, with the help of AI adoption. In the case of the Eurozone, the unemployment rate ticked down to 6.4% in January from 6.5% in December. This is the lowest level recorded since the introduction of the euro in 1999. What this says is that the high unit labor cost growth is not yet putting a brake on hiring. I suspect that labor shortage in 2022 and 2023 is encouraging labor hoarding behavior. Indeed, a new European Commission survey shows elevated levels of labor hoarding, especially in Germany and France. But this cannot be sustainable, as profit margins of European companies come under increasing pressure. My guess is that labor hoarding in Europe will gradually unwind in 2024, and that wage growth will slow faster in Europe than in the US for the remainder of this year. If I'm right, the ECB will end up cutting interest rates more aggressively than the Federal Reserve. My view also reflects the risk that the Fed has not yet gotten inflation under control, and that with financial conditions so easy, US interest rates will stay higher for longer. I continue to see more upside than downside for the US dollar. Of the major currencies, my expectation for the rest of 2024 is that the dollar will outperform the yen, which will outperform the euro and the RMB. If you got something out of this program, please hit like and subscribe to my free YouTube channel. Let me know what you think by posting your comments on the video. If you want to learn more about my investment strategy, come visit us at davidwuunbound.com.